Hey everybody, it's Larry Berman here, coming to you in the last hour of trading on Friday, options expiry day. Kind of a quiet day, dog days of the summer in front of us here. I'm wearing my Alpha Seeking Pac-Man shirt here, and there's not a lot of that out there these days. Got a couple charts to look at, but really, it looks like the market is going to mail it in between here and Powell's speech this coming week, where we expect him to be very, very clear that while 50 basis points might be on the table, it's only on the table should the employment situation get dramatically worse, which this week was survey week. Initial claims was weaker. Probably means the payroll report might be soft-ish, but not tragic. And it's unlikely that we see 50 from the Fed. So markets probably got a little bit repricing to do. It is clear, though, when we get a disappointing economic number like we saw Friday with the housing starts data, and that we've seen periodically, that the market is very hypersensitive. Slightly better retail sales numbers this week. Market got a big boost. Slightly weaker housing market initially, anyways, reacted negatively. Let's take a look at a couple of things we're looking at in the chart room while vacation period is on for most. So a lot of talk earlier this week about the yen carry trade, and it really came on Friday and Thursday after we saw the yen pop here outside the consolidation range post meltdown and recovery. Now remember, in here, governor or deputy governor, I think it was, of the Bank of Japan, kind of indicated that they weren't likely to step on the rate hike cycle path if the markets were going to be volatile, and subsequently, in at least my lens, was the major catalyst for the market bounce, and this week confirmed by somewhat softer and more friendly inflation data. So when we look at this Friday, we kind of see, okay, did a bunch of leverage get put on into the strength this week, and now is maybe at risk to a gap to the downside? Who knows? Geopolitically, we're not hearing anything that's imminent, although that is the persistent threat with Iran and Israel stepping it up a notch significantly. A lot of troop movement defensively from the U.S. and Great Britain this week to mitigate that. When we look at the vol curve, that is interesting. Friday, again, at this point here, as I'm looking at the tape, S&P's up about 0.25%. Russell's up a little bit more, but we're seeing a slight uptick in volatility in the back months. So that, again, market is grinding here, but guys are paying up a little bit for protection, looking out a bit. So that's interesting to note. And the chart of the week here that I want to look at is the Qs, because remember, leadership, you always got to look at that. And so very key inflection point on the charts here. When we look at the July 31st post FOMC high, right at the key Fibonacci retracement on the Qs. The next day we shot up early and reversed, if you remember that, on August 1st. So this day behavior is pretty critical. We're up against that now. Do we break through early next week, or does this key chart level get rejected? Flip a coin. I'm not sure which way it's going to go. If I was aggressive right here, I'd be a seller, but and not a buyer. But if we do see this leak through next week into Jackson Hole, Powell speech, then we would expect this gap to get filled and possibly a retest into Jackson Hole. So why would the Qs rally up a bit more than 5%? if he's not going to deliver 50? And the answer is it probably shouldn't. So risk reward here is good on a short sale or a trade to the downside. We have to think some of these levels are going to be retested in the coming months with all the uncertainty coming into the U.S. election. Anyways, that's all we have from the chart room this week. It looks like a pretty lousy weekend here for rain in the GTA. So golf is not going to be plentiful. So I'm running off to get 9 in right now before the rain comes. Anyways, have a great weekend, everybody.